For the next hour, you'll be leaving the show me state and entering the show me the money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. Then we'll discuss how to handle market losses in your 401k if you're close to retirement. We'll talk about planning for long-term care and hybrid long-term care policies, and then discuss what to expect with the Floyd Financial Group Complimentary Review. My name's Jeff Shade, and as always, I'm just here to ask the questions. But the words of wisdom and solid advice, they come from Jake Floyd this morning of Floyd Financial Group. Good morning, Jake. How you doing today?
I'm doing great, Jeff. Thanks for asking.
You're certainly welcome. Happy Easter, Jake. Now, you and I have read the Bible, and I don't recall any place in the Bible where there's a story about a long-eared, cotton-tailed creature known as the Easter Bunny.
You know, I haven't read that part. I think that a lot of the holidays, though, that are built around Christianity seem to have gotten sidetracked over the last several years, I suppose.
Yeah, well, there is also not a passage about young children painting eggs or hunting for baskets overflowing with scrumptious Easter goodies. And when you think about it, real rabbits, they don't lay eggs. They give birth, live birth, I think, just like a lot of other mammals. But anyway, I think what it is...
I have a chicken that lays blue eggs.
Do they taste any different from the regular egg?
No, not really.
They're just blue eggs. Well, you got a special chicken there. I'd hold on to that one. I'm telling you right now. But anyway, I understand that, the Easter Bunny is a symbol, I guess, of spring and new things and fertility. And if you've ever had a couple of rabbits together, you know that they do procreate quite significantly. But anyway, let's get back to what we're talking about here. Happy Easter, everyone. I hope you have a safe and a wonderful celebration with family and friends. Okay, Jake, let's dive into what's going on in the world today. Let's talk about the market. So many people are reading about the market. The S&P 500 death cross, the first in 3 years. That was a headline yesterday, sort of made to probably catch my attention, and it certainly did. So what is the death cross, and do we need to really worry about that?
Yeah, so the death cross on any security or market-based entity is when the 50-day moving average of that crosses over to the downside, its 200-day moving average. So it's a very technical signal. I say it's very technical. It's not that technical, but it is technical. When you look at the market, there's fundamental analysis, which is where we're analyzing earnings and cash flow and debt to equity ratios and things like that. And then there's technical analysis. What has the stock done recently? Are there certain patterns we should be paying attention to? And so the death cross is arguably not that meaningful, but at the same time, it only typically happens when we have slowdowns or recessions or shocks to the economy. So based off of these tariffs and some of that type of news that we've had in recent history, that's what's created it. Whether or not it'll stay down there is another story. When it goes back the other way and the 50-day crosses over the 200 to the upside, that's called a golden cross. And so for every death cross, there's a golden cross after.
So the pain basically is going to be short-lived if there's much pain at all. But anyway, the death cross has certainly got my attention with a headline. But what you're saying is that it's really nothing to be terribly worried about. Let's talk a little bit about what the stocks have done here. They're really up and down with Trump's tariffs and so forth. I understand that he suspended these tariffs for around 90 days. The market did react up a little bit.
Yeah, so I guess it was week before last when we had these tariffs, he put a 90-day pause on a lot of them. We still had 10% on everybody. We had 25% on Canada and Mexico. We had first 54, then 85 or something, and then 125, and then 145 on China. There was this big reaction out of the market when he put the pause on there. I think that was twofold. Number one, I think he did the pause because the bond market was freaking out a little bit. And he kind of publicly turned to Jay Powell and said, "Are you going to do anything about this?" And Jay Powell said, "Hey, man, this is your mess. Clean it up." And so rather than letting people suffer, because if the bond market really blows up, it's not going to be good, he decided to go ahead and step in, put the tariffs on pause, quote unquote. However, the market sniffed out the next day that basically 70% of the tariffs are not on pause. And even though it went up that day, it's like the third best day ever in S&P history, 9.5%. The next day, it retraced 7.5% of that at the worst point, and then closed down like 3.5, 3.75, something like that. So I think we're not out of the woods is really the long story short here. We saw earnings growth start to slow down middle of last year. This last month, we had both CPI and PPI, which are inflation measures. They're both negative for the first time since 2020. So, we're seeing a slowdown. And if we keep the 10% tariffs on everybody, that's going to probably continue. And we'll have a technical recession. Whether or not it feels like a recession is another story, but where we'll have GDP falling slightly for a couple of quarters. But all that to say, I do think this is going to end up being a very good buying opportunity. But if you're nearing or in retirement, you need to have a plan to deal with this volatility. And so if you don't have a plan, that's what we're doing here on the radio, just try to help people understand retirement, help them understand the market. You want to buy low and sell high is the idea. That's easier said than done, right? Because that means you got to be buying when things are falling apart and selling when there's nothing wrong. And that's easier said for sure.
Yeah, and I think Warren Buffett said to buy when there's blood running in the streets. Talking with Jake Floyd, Floyd Financial Group, we're talking about the market and having a plan. You're listening to the program right now. You want to get your plan. 417-889-7233 is our telephone number. 417-889-7233. There's no cost, no obligation, certainly no judgment. We'll meet you where you are. If you'd like to talk to Jake here at Floyd Financial Group about your plan, again, call that number. You can do it right now if you want. Leave your name, telephone number. Lovely Ashley will call you back during the week and set up a time for you to come in and sit down and talk with Jake, maybe Randy when he is in the office. And again, there's no cost for this whatsoever. 417-889-7233. Jake, before Trump paused these tariffs, I understand that Apple discreetly chartered 6 cargo flights to ferry 600 tons of iPhones out of India to the U.S. at the end of March. I think it was like 6 planes carrying 100 tons of iPhones to the U.S. to circumvent the tariffs. Did you hear that one?
Honestly, Jeff, I'm not sure that I did hear that. That's a little bit of a dangerous game to play. But last week, Trump exempted phones, computers, semiconductors. So it looks like Apple's going to be somewhat in the clear for now. However, there are tariffs on a lot of components that are used to build the iPhone. And so probably not all of those, like screws and things like that go into the phone, are going to be exempt. So it'll be interesting to see how long this lasts. But for now, it seems like Apple has gotten a little bit of a pass here, and they might not totally implode, because if they kept those on from China, that would have been very difficult for them to, if the tariffs on the iPhones themselves, an iPhone at the same profit margin would have been like $3,400 in the U.S. So.
Well, 600 tons of iPhones, I don't know how many iPhones that would be, but it's got to be a lot. But anyway, the cargo planes each reportedly had a capacity of 100 tons, and they were filled with these iPhones, and they came in from India. This was at the end of March. So the source of that story about the Apple iPhones was Reuters, and they usually do certainly vet these stories. So I've seen it in multiple news reports, so we'll take it as maybe true, but maybe not. Who knows? The bond market has had a sell-off here, and really, when the bond market sells off, Jake, is that more worrisome than the one in stocks?
I would say categorically, yes, it probably is. So imagine, if you will, for a minute, that you are a person.
I'll imagine I'm a person.
Imagine you're a person, and every time you buy something, you rake your credit card. So you just rake the credit card, rake the credit card. For groceries, rake the credit card. Your car, rake the credit card. Gas, credit card.
Right.
And you never make any payments. You just keep raking the credit card.
Mm-hmm.
Eventually, the bank is going to say, hey, no more. And it's no different with our bonds. If we are spending money in this country at this point, because we spend so much on entitlements and interest to our debt, if we're spending money, it's money we don't have. Therefore, we are issuing treasuries to pay for that, whatever that is. And if people stop buying those bonds, then a lot of these entitlements that people are so attached to, Medicaid and food stamps and all that kind of thing, not only are they going to get cut, they're going to go totally away. And so a lot of the left doesn't seem to understand that you can't just simply issue debt forever without making any payments and make it bigger and bigger and bigger in perpetuity. So when the bond market sells off, it's because people are not buying bonds or they are selling bonds. And so that's usually not a good thing, especially if it gets out of control. It's kind of a normal, healthy thing that happens when the stock market goes up, where people are fleeing safety into risk. But especially when you have a situation where bond yields are going up and the market's crashing, that's typically a not so good sign.
Jake, we've talked many times about these headlines, that they're meant to get people's attention and to evoke emotion. How would you say that we would suggest that our listeners take these headlines when you see the tariffs are causing all this havoc, so to speak, and that the market's up, the market's down, 401ks have been decimated and so forth? I mean, what is the answer to all of this? If you're an average intelligent investor, how should we really decipher what the news is telling us?
So it kind of depends on where you're at in your life's journey here. Meaning, if you're 40, you shouldn't be worried about it at all. Keep funding that 401k, keep investing. You're just buying shares at a discount. If you're 5 years from retirement, then this should be somewhat concerning, although I think there's plenty of time for you to make it up. If we're 2 years from retirement, then that's a different story, and it really is going to depend on your specific situation, what we should be doing. But having a plan ahead of time to deal with this volatility is really the best way to go. And just understanding that when this stuff happens, and it does happen, people have pretty short memories. In 2022, the market was down 28%, peak to trough. And so that's really not that long ago. It's just been a while since we've had the volatility. And so now that we're having the volatility back, a lot of people are kind of panicking, and it's important to be honest with yourself risk tolerance wise. One of the things that happens when we have a really good market for a year or two is something that I like to call risk tolerance drift.
Mm-hmm.
And so when we're talking about risk tolerance, that's how much risk are you comfortable with, right? And the longer the market goes up without a significant correction, people that are really a maybe 50-50 risk tolerance, meaning they have 50% of their money at risk, 50% safe, they start going, why do I have this safe money? It's just costing me a return. Let's go to 70-30, or let's go to 100-0. And then when you have these events, they're like, oh, I didn't know the market could go down, which seems crazy to think about, but this is when the safe part of your portfolio earns its keep. And so having a portfolio that works in all kinds of weather that'll help keep you invested so that you can weather these storms and come out the other side better is really what the plan is about.
And I think the common theme of our radio show has always been to have a plan. If you're hearing the program today, you do not have a plan, or maybe you have a plan from somewhere else, you're not sure whether this is the right plan for you, we would be happy to take a look at it for you at no cost and no obligation. If you don't have a plan, certainly we can get you started on that. Our telephone number, 417-889-7233, 417-889-7233. That's the number to call to get in touch with us here at Floyd Financial Group. And certainly you can get in at no cost, no obligation, and no judgment. We'll meet you where you are. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, time for a break. When we come back here on Show Me the Money, we'll be talking about how to handle 401k losses if you're 3 years away from retirement. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about how to handle 401k losses if you're near retirement in a day like today.
That's right, Jake. And that's a tough spot to be in, especially when retirement is so darn close for you. But you're not out of options. So let's talk about some ways that you can stay calm, give a practical approach to dealing with 401k hits when you're really close to retirement. So, Jake, for someone who's taken a look at their 401k statement, a lot of people are opening up their 401k statements these days and going, oh my gosh, look at the losses that I'm taking. I wanted to retire here pretty soon. What would you say to those people? What's the first thing that you would advise them to do?
Do not panic.
That's hard to do, Jake. We're emotional animals.
It's easier said. Yeah. Easier said for sure. I think that panicking, though, is the worst thing you can do. Again, I know we're like a broken record on this show, but having a plan in place that says, okay, if the market goes up, here's what I'm going to do. If the market goes down, here's what I'm going to do. If my 401k goes down, reassessing what you're doing and going, okay, it's down now. Here's how I'm allocated. Here's what I think is coming up next. And nobody really knows what this market is going to do. However, we know that stocks are a lot cheaper today than they were 2 months ago. And so generally speaking, if you want to buy low and sell high, buying when stocks are down is the way to do that. However, we don't know whether we're at the bottom or whether we're close to the bottom or not. And so we need to really take a good hard look at our risk tolerance and make sure that we are allocated in such a way where we're not going to be panic selling the bottom of this thing. Because a couple of weeks ago when we had the Thursday sell-off, Friday sell-off, and then that Monday sell-off where we touched the lows there, I had a lot of people wanting to jump out of there. And I had a lot of conversations with people. I said, hey, if you want to jump out, that's fine. I was like, but let's give it a few days because we're way oversold. We're likely to have a big bounce. And then that might be a good opportunity if you're wanting to head for the shed.
Right.
Maybe we do it then. And sure enough, 2 days later, we had a 9.5% rally, which is a gigantic move. I wish it would have given it to us, frankly, over more days. Having it all in one day like that, a lot of people missed it. But that's the way the market does things. When the volatility is high, it goes from moving 0.5% per day to 5% per day. And there's a lot of money to be made, a lot of money to be lost if you're not careful. And so sometimes the right thing to do is nothing until we have better information.
Right, and that's the fundamental that we've talked about a lot here is to buy low, sell high, and people want to do just the opposite when they're in panic mode. And of course, when you're in panic mode, you don't make the best decisions. Next one, I think, is to reevaluate your timeline. Is it ever a good idea to say, really, I wanted to retire in a year? I don't think that's possible now. It would be better in 2 or 3 years. I know you said that the market tends to bounce back, but should you reevaluate your timeline?
That really is going to vary a lot person to person. It depends on how much you have saved. If you've just barely saved enough to where this downturn here is enough to throw you off your game, then you might have to. But for the most part, the move we've seen so far is not enough to force you to delay retirement. However, if you have questions about that, that's what we're here for at Floyd Financial Group. We're kind of geared toward helping you understand what an appropriate amount of money is to withdraw, what you can expect looking forward. Again, we don't want to take kind of the maximum amount we can take right off the bat off your retirement assets because we leave some room for inflation, right? If you're retiring at 60, we need to count on it costing at least double later in your retirement what it does now. And so we need to leave room to increase income over time. But I do think that reevaluating your timeline as far as retirement is a thing. But if you've done a good job saving, I don't think that this move is big enough to throw you off your timeline just yet. But that's something we can talk about when you come in for your consultation.
And if you'd like that consultation, our phone number is 417-889-7233. You can make that call this weekend, 417-889-7233. Talking about what to do if you take a look at your 401k and it has dropped a bit. Should you shift into preservation mode, Jake? Many times 401ks are made of stocks. Maybe you want to rebalance towards a more conservative alternative. And if that is the case, what are some of those conservative alternatives that we might want to consider?
Sure. So if you're under 59 and a half and you have your 401k, you're kind of confined to that vehicle. So inside there, you have stocks and or bonds and funds that you can choose, a pre-selected group of funds. And so generally speaking, and this is not always the case, but generally speaking, if you move from stocks to bonds or some of the money from stocks to bonds, that'll help weather some of the volatility and make things smooth out a little bit for you along the way. If you are over 59 and a half, most plans will allow for an in-service distribution where you can roll your money out to an IRA with no taxes. And then the world is your oyster as far as what kind of investments that you want to use. You can use anything from gold to real estate to annuities, that kind of thing. There's all kinds of different things out there right now. In fact, some of the fixed index annuities look pretty attractive here because interest rates are still relatively high. Just last week, we had some of the carriers increasing rates again, and they're already at historic highs. So with those vehicles, you can get safety and gains linked to the market. So it's definitely a good option that we can talk about. But just understanding how you're positioned relative to the market. So if the market goes down 10%, what's going to happen to your portfolio? And if you can't answer that question, then you need to have a plan. Because if you don't have an answer to that, then you're just at the mercy of what your portfolio does to you. And we should be a little more pointed about that and go, okay, if the market goes down 10%, I want to have half the volatility of the market. I want mine to go down 5. And if the market goes up 10, then, I'm going to go up 5. Evaluating risk tolerance is a big deal, and it's probably one of the most important things to do as you're getting closer to retirement.
Jake, would you say that if you're close to retirement, close is a relative term here, let's say that you're 3 years away from retirement, you're worried about the market, would you suggest maybe building up more of a healthy contingency fund instead of 3 to 6 months worth of living expenses, that maybe we try to put it together maybe a year and a half, and put those into some sort of safe investment? Would that be a way to sort of make yourself feel a little bit better? Because then you've got some time to wait till the market bounces back.
Yeah, I mean, I think that's one way to approach it. But I do think that lifestyle plays a lot into how much you need to have on the sidelines ready for you. If you're a big spender and you're used to a healthy income, you need to have more than somebody who likes to fish off the bank instead of off his $100,000 bass boat, right? Because things just cost more, and boat stands for bust out another 1,000, by the way.
Yeah.
And so, if you have a $100,000 bass boat, you're probably spending thousands and thousands more. Another definition of boat is a hole in the water into which you throw money.
That's right.
Just picking on the boat owners out there. If you own a boat, we love you. Don't take offense.
We know what you're talking about.
but I guarantee if you own a boat, you're nodding right now as I say that.
Yeah.
However, what you want out of your retirement is a really big deal. And us understanding how to meet you where you want to be, not necessarily where you're at, but how to get you to the retirement that is what you're looking for. So we have to understand what it is that you want first before we can go about that. But those are all things that play into how we go about preservation in a time like this. And realistically, I think sitting here right now today, while I don't think this is over, I do think the market will be higher than this a year from now, even maybe 9 or 10 months from now. Now, I can't guarantee that, but I personally think that's what's going to happen. But we have to weather this storm, and you have to be able to sleep at night in the process.
If things get a little hot in the market, Jake, people tend to jump out of the frying pan. Would you say that probably the best advice that we can give to people is to stay invested? But you do want to do that wisely. Never a good idea, I think, and correct me if I'm wrong, to jump in and then jump out of the market on a regular basis.
Certainly not on a regular basis. There are people that have experienced that risk tolerance creep I was talking about, where sometimes I open up people's 401k statements and they're all in large cap growth, right? Which worked really good over the last 2 years, but some of those people are down 30% peak to trough in that 6-week period we just came through. So I think selling, quote unquote, or potentially reallocating is not out of line, but we certainly don't want to take our ball and go home.
Jake, speaking of conservative investments, can you really go too conservative too soon? I would think that can hurt more than help if inflation eats away at your purchasing power.
100%, Jeff. And I think you can ask anybody who saved money in the bank in CDs over the last 15 years prior to the last 3. Interest rates were basically zero. CDs were paying 0.25, 0.5, and inflation was definitely more than that. And so eating away at your purchasing power, yes, but also what we'd really like to do if we have our druthers, as I like to say, is let's have our principal make us enough money on the average year to pay for the income that we're taking so that we can have our cake and eat it too, rather than stuffing it in the mattress, pulling out 5% and then being out of money in year 20 because 5% per year lasts 20 years. We want to have some growth in there so that we can extend that to 30 years, 35 years, or forever if we do a decent job at it. And so, yes, you can definitely take too little risk. You can definitely take too much risk. And as with a lot of things in life, it's better with moderation, but it does depend on your specific situation. There's no blanket answer for everybody.
Jake, if people are worried about their 401k, would it be an option to convert that into an IRA? Would that give them more control and less exposure to the market?
Yeah, so when somebody comes in with a 401k, especially if they're still working, the first thing I do is we want to look at the 401k and see what options they have inside there. Because there are some pretty good low-cost options, and some of the 401ks are not very expensive, and you don't necessarily need to roll it out. However, there are a lot of 401ks that don't have very good options, and the best thing to do is roll it out to an IRA. Again, no tax consequences to that, and then have more investment choices. For the most part, all things equal in life, more choices is better than less choices.
I would say that 100%. So if you're listening to the program today, you've opened your 401k statement, you're aghast at what's happening. Number one, do not panic. I think what you should do is call Floyd Financial Group at 417-889-7233. We'd love to take a look at your 401k. But, even with a big drop, time and steady contributions can help you recover. You could also delay retirement if that's in your playbook there. Even just 1 or 2 years gives you multiple benefits, gives you time for more growth, bigger Social Security, and fewer withdrawal years. And, you could go conservative, but again, that could be a problem as well, too. So if you've got a 401k that is not performing the way that you would like it to perform, it's subject to too much market volatility. Let us take a look at that for you here at Floyd Financial Group. We can do it at no cost, no obligation, certainly, and no judgment whatsoever. Our phone number again, 417-889-7233. You can make that call this weekend if you want. Leave your name, telephone number. Ashley will call you back during the week. She'll set up an appointment for you to come in and talk with Jake and or Randy when he's in the office to talk about your 401k and your investment options and your journey towards a confident retirement. We'd love to meet you. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, let's take a break. When we come back, we'll talk about planning for long-term care and a hybrid long-term care policy. When our program continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpa, Jake Floyd.
Welcome back to Show Me the Money. I'm Jake Floyd. In this segment, we're going to be talking about long-term care, everybody's favorite.
Yeah, and planning for long-term care, it's really, really smart, especially as we get older and we want to protect ourselves, our spouses, and our savings. And I was thinking if all the things that could happen to you in life, long-term care is one of those things that probably is going to be more of a factor in your life than almost anything. If you have reached a certain age in life, let's say 65, and you're still in reasonably good health, there's a chance that you're probably going to need to have long-term care, and it's not exactly inexpensive. So let's first of all talk about what long-term care can cost, Jake. What are the costs of long-term care typically here in the last bastion of sanity, Springfield, Missouri?
Yeah, I would say for most people, it's probably the most expensive thing you'll ever do. So in the last bastion of sanity here, we're seeing $7,000 to $8,000 a month for a skilled care facility. And I think the one that's maybe even more shocking is some of the ALFs, as we like to call them, the assisted living facilities, are now $4,000 or $5,000 a month and up. And so it wasn't too long ago, maybe 15 years ago, that you could get assisted living in like the $2,000, $2,500 range. That stuff has gone up a whole lot, and it can really eat into a retirement. I think probably the most important consideration, though, is not so much you spending your money. It's you spending money that your spouse is going to rely on if you are no longer here. And so if you go, let's say you guys have collectively $500,000 and you guys are using that to live on. Then one of you needs to go to the nursing home. And let's say that person spends 4 or 5 years in the nursing home. Well, when you couple that with your other spending, you might spend all of that money between retirement and the nursing home over that 5 years. So what is the spouse supposed to do? The stay-at-home spouse, as we call them, meaning the one that's not in the nursing home. What's that person supposed to do when you're no longer here? So having a long-term care plan of some sort is a good idea so that you do not impoverish your spouse.
And as you said, Jake, some of these facilities could cost as much as $8,000 a month. Times 12, that's $96,000 a year. And then times the average stay, maybe, let's say 3 years, you're getting close to $300,000. And some people may think, well, Medicare will cover that, but Medicare does not cover nursing home, does it?
Right. Yeah. So Medicare is designed to cover acute things you'll get better from. Once it's long-term care and it's flagged long-term care, they're not going to pay for that anymore. And so long-term care insurance is out there. There's basically 4 ways to pay for that care. There's insurance, out of your hip pocket, Medicaid, and some sort of veterans benefit. Those are the 4 ways to pay. So if you're not a veteran and your spouse is not a veteran, you'll have to take that one off the table. Nobody really wants to pay out of their hip pocket. If you are 65 or older, in a lot of cases, it will not make sense to buy actual insurance. Now, there are some hybrid insurance annuities and life insurance policies out there that can make some sense, but your traditional pay for a certain daily benefit and then, 20, 30 years from now, you use it for a nursing home, those things are so expensive. And even if they're not too expensive in the beginning, they can raise your rates at a moment's notice. In fact, during the late teens, 20 teens, we saw lots of carriers were raising 30% year on year, 40% year on year. And that's after they raised 20% the year before and 15% the year before. So you might start paying a few $100s, but by the time you actually need to use it, it becomes too expensive and you have to drop it, and then you actually need it the next year. Not a huge fan of traditional long-term care insurance unless you're very young, but there are some asset-based long-term care policies that can make some sense.
Okay, so long-term care policies for many people, not an option. As you said, the premiums can get too high, and it's one of those things that if you don't use it, you're certainly going to lose it. So that leaves us to the other options. You said asset-based long-term care. How does that work? How do we self-fund long-term care?
Yeah, so the basic idea is, let's say we set aside $100,000 to pay for care. There are policies that we can do joint money. We can use IRA money, meaning we can set up the husband and wife both for this $100,000, and it becomes up to $300,000 for long-term care. And so basically, if you need care, you have up to $300,000 for that $100,000 you set aside. And what you really give up is the earnings on that money. If you pass away not using it, your beneficiaries will get a death benefit of a slightly higher amount than the $100,000 that you put in. So that's one option that a lot of people like. There are some more performance-based annuity contracts that will allow us to make more money on that money, but the expenses on it sometimes are prohibitive, where the actual net that you receive and the amount of care that you receive are maybe not as good.
Talking with Jake Floyd of Floyd Financial Group about long-term care. Again, you've got questions, 417-889-7233. 417-889-7233. You can make that call this weekend. Leave your name, number. Ashley call you back during the week and invite you to come in and sit down with Jake and talk about the long-term care options for you. So let's continue to explore some of these options. As you said, you can pay out of the hip pocket. Most people not plumbed for that. If you are a veteran, there's a thing called aid and attendance. Certainly there are some requirements to meet that. Of course, if you're a veteran, check with your Veterans Administration on that. It can help with long-term care. Long-term care policies, maybe not the best option. Asset-based long-term care. Let's talk a little bit more about these hybrid long-term care policies. There are policies that will give you life insurance plus a long-term care rider. How do those work?
Yeah, so there are policies out there where you can set up, let's say, $250,000 death benefit. And if you don't use it, obviously you get the death benefit. But a lot of those have riders on them that allow you to accelerate the death benefit ahead of time if you have 2 out of 6 ADLs. So ADLs are activities of daily living, so eating, medication, toileting, cognitive, transferring, those types of things. If you cannot perform 2 of those, then that money is able to be accelerated to you to pay for care. What's nice about that is you can use it to pay for in-home care or assisted living or finally nursing home. I don't think anybody wants to go straight to a nursing home, right?
No.
So it gives you a little bit more options. And the policy I was talking about a minute ago does that as well. The annuity-based ones will also allow you to have in-home care. And so in a lot of ways, life boils down to choices. Either you have choices or you don't have choices. And these types of policies will allow you to stay at home longer in a lot of cases than if you don't have them.
So the first choice here, life insurance plus a long-term care rider. Let's talk about an annuity plus a long-term care rider. How does that work?
Yeah, so again, those are able to earn money as time goes forward. So like typically your life insurance policy with a rider on it, you're going to want, as my dad would say if he was here, the mostest for the leastest, meaning, meaning you want more death benefit, less premium to maximize your benefit there. The annuity ones, depending on what we're talking about, there's quite a few different types. But there's some of these that will earn pretty good money even while you're in there. The leverage, if you will, meaning what I was talking about before, where we get 3-to-1 on our money, that type of thing is less good on ones that earn money, but you do have the money. And so you have to kind of decide whether it's okay with you to set that money aside for care purposes or whether we want to kind of have dual purpose. We want to try to make it earn some money in case we need it, but then also have some benefit for nursing home if we need that. Each situation's a little bit different based on what you've saved, based on your guaranteed income, your spouse's guaranteed income, what kind of holes we have to plug in those situations. So there's a lot of different products out there that can be used for this purpose if the situation calls for it.
And Jake, you talked about Medicare a bit there, and Medicare, of course, only pays for things you'll get better from, and it pays for up to, I think, about 100 days, something like that. But as a last resort, then there is Medicaid, and Medicaid will pay for some nursing care. I don't think most people do want to go the Medicaid route, but some people just can't help but get there at some point in time. Now, if you do go that route, if you have to have Medicaid, can the nursing home come back and take the money from your estate that they paid for your Medicaid?
100% they can. So depending on the situation, they just won't pay in the first place. So if you have too many assets, if you're over-resourced, quote unquote, they'll just deny your Medicaid application. So Medicaid in the state of Missouri mainly pays for nursing home. They're not going to pay for in-home care or assisted living unless there's a very specific set of circumstances, which most people will not like. For the most part, we're talking about nursing home at that point. But every check you ever made while you were working, you paid into Medicaid. So I don't have any issue I don't tell people to send their Social Security check back because they paid into that their whole lives.
Yeah.
The same thing is true of Medicaid. Medicaid was originally designed to pay for seniors in the nursing home. And it has been repurposed to pay for birthing children of unwed mothers and all kinds of other things. But Medicaid, you can get help from Medicaid without spending all your money down if you know what you're doing planning-wise. There's nothing underhanded or illegal about it. We simply use what the Medicaid manual tells us, and we're able to reposition assets in a way and help get you qualified for benefits. So it kind of depends on your situation as to how that would work. But if you simply go in, you got $100,000 in your 401k and you say, hey, I want Medicaid to help pick up some of this bill, they're going to say, you got to spend this first. But there are ways around that if you know what you're doing planning wise. And again, we're using their rules. We're not doing anything underhanded, but there are ways to get Medicaid to help us pay for some of the bill. And because you paid into it your whole life, I think that's something that we ought to look into.
Yeah, and there are ways to save the family farm from the nursing home. Randy has talked about that in the past. And as you said, I mean, this is nothing underhanded. These are totally legal methods that we use here at Floyd Financial Group. But you can't just say, hey, look, mom or dad is going to need a nursing home in about 6 months. We're going to start transferring all the assets away from them. There really is a timeline here that's really important, isn't there?
Yeah, so if we're going to try to get around it by transferring assets, there's a 5-year look back on that kind of thing. So they say, hey, if you've made any gifts at less than fair market value to anyone over the last 5 years, we need to know about it and we're going to hold it against you. Okay, that's a little bit of an oversimplification, but that's basically how it works. So we need to keep that in mind as we're doing this type of planning. There's pre-planning where we can use trusts and other vehicles to help us plan ahead of time so that things are not held against us when we go to file for Medicaid. But then there's also crisis planning, where let's say we haven't done any planning and we have somebody in the nursing home right now, then there's a different set of steps we can take to try to preserve as much of the assets as possible. In some cases, we can save nearly everything. It just kind of depends on your situation, and that's something we can talk about.
Jake, if someone's listening to the program today, they are awakened by our conversation here about long-term care and the fact that it is going to be very likely for a lot of people. Let's say that they're age 60, maybe they're early 60s. Is it too late for them to do something about paying for long-term care, such as using life insurance with a long-term care rider?
Yeah, so life insurance specifically has some health considerations, but the age itself is not a problem. If you're relatively healthy, we can still do something there. And that would give you more options than obviously filing for Medicaid, where you pretty much have to be in a nursing home to get those benefits. So again, as always, and I know I sound like a broken record here, but having a plan to deal with these things is generally the best way to go, where we come in and we talk about it beforehand and kind of assess where we're at and where our gaps are and what we're doing and try to fill those gaps before they become a problem. That's the best way to go.
Yeah, you said like a broken record. Let's update that to a skipping CD. Well, maybe not even a skipping CD. I hate to sound like a buffering internet stream, but nevertheless, you've got to have a plan. That is so important with long-term care. So you're listening to the program today. You do not have a plan for long-term care. In my estimation, if you don't have a plan for long-term care, you do not have a complete financial plan. So if you'd like to talk to us about long-term care options, 417-889-7233. Make that call this weekend. Set up an appointment with Jake or Randy. It's not going to cost you anything. Absolutely no obligation, no judgment. 417-889-7233. Let us give you a helping hand with long-term care. You can also find out more about us online at FloydFinancialGroup.com. Jake, let's take a break. When we come back, we're going to talk about what this Floyd Financial Group complimentary review consists of when our show continues right here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. In this last segment, we're going to be talking about what it looks like when you come in for a review, what you can expect.
And Jake, so many people hear us talk about the opportunity for them to take advantage of every week for this financial review at 417-889-7233. And if you're not a regular listener to the program, I'm sure you're wondering, well, what exactly is this? What's going to happen when I get in there finally in front of Randy or Jake at Floyd Financial Group? Are they going to shine a big bright light in my eye, or maybe not let me leave as sort of like a timeshare salesperson, until I've signed on the dotted line? That could not be further from the truth. So let's shed a little light on exactly what we do here at Floyd Financial Group when people do come in for this review. There's really no pressure. There's absolutely no obligation. In the first meeting, really, we just sort of get to know you. It's a very casual conversation, sort of like visiting.
Right, Jeff. And I think the very first thing we do is we call it discovery. And that just basically means we're going to get to know each other. It's relative to investments and where you are that way, but it's also, and probably even more so, about what's important to you. What does retirement look like to you? Do you have beneficiaries, or are you going to leave everything to charity? Do you have kids? Do you have a spouse? We have to kind of get a picture of who you are and what's important to you. And like I said earlier, do you like to fish off the bank, or do you like to fish off your $100,000 bass boat? Right? Because that kind of determines a lot about our plan. And so before we can create a plan, I have to really get to know you. And then that does include, like I said, your financial assets, but it is more than that. And there's a lot of, more than half the questions will be more about lifestyle and what you want to do with all your newfound time after you get retired.
And when Randy sits in on these appointments too, he sort of gets into a real visiting mode there where they talk about, hey, aren't you from Bradleyville? Yeah, didn't you have the general? Oh, yeah, my uncle used to go in there. These conversations can veer off rather personal, but that's the way we are here at Floyd Financial Group. As you said, we want to get to know you, kind of what your assets are, but we also want to get to know you. Are you married? Do you have kids? Do you have grandkids? What your priorities are? What sort of lifestyle are you going to lead? And then we'll begin to try to plan around that. So again, that's the nature of how we do business here at Floyd Financial Group. We're going to treat you like family. So in the beginning, don't bring your checkbook. Don't bring anything. You don't have to pay for anything. There certainly is going to be no judgment whatsoever. As I always say, we will meet you where you are. So once we've discovered you, we've found out, 6 degrees of separation from Randy Floyd, and we've gotten all that out of the way. Then it's sort of, as Randy said, to get down to talk about the scary money stuff. That's what one lady said when she was in the office. I guess we should talk about this scary money stuff. So next step is going to be analysis. Now, does this happen during the first meeting?
So the analysis kind of happens between the first meeting and the second meeting. So after we've done our discovery process, then I kind of go back and go to the drawing board and say, okay, what's the best way to handle this situation? What types of products do we want to use? What types of investments do we want? How much risk is this individual comfortable with? Maybe you have unlimited risk tolerance, maybe you have no risk tolerance, or anything in between. And we kind of evaluate what the best way to approach this is. So we get spreadsheets out if necessary and kind of go through everything and try to put together the best plan for you that we can. And so the planning is the third one, but analysis is really understanding what you have and what you need to get out of it. And so that we can kind of make that fit in the plan the best way for the best outcomes.
Okay, so the first meeting is in person. That's the discovery meeting. And as you said, behind the scenes, that's where the analysis comes in. Okay, so we've done the first meeting and we've decided, okay, well, let's go a little bit further with this. And of course, it's always an option to say, no, I don't want to go any further. But the vast majority of people do want to go further. So let's talk about this planning session. Is that the one that is done in person, or is that behind the scenes as well?
Yeah, so planning is it's partially behind the scenes, but this would kind of be the second meeting where I say, hey, here's kind of what I think we should do based on what you've told me. And then you'll have an opportunity to say, well, I kind of like this, I kind of don't like this, and ask questions and really kind of get a feel for what I'm talking about. And that is really the planning process, I feel like, where Because again, this is not just like I dictate this to you and that's it. This is your money. This is your life savings. And I don't forget that. There's a lot of financial advisors that forget whose money it is, right? This is your money. And I want to make sure that you have some input, and I want to take the time to explain things to you so that you can make a good informed decision. And so as we're going through this process, sometimes the plan shifts a little bit in that second meeting where we're like, okay, Jake said we should do this, but I forgot to mention this and this. And so we need to adjust the plan just a little bit. And that's kind of what happens in the second meeting.
So the planning process, this is where you are in front of the whiteboard, you explain things out. You know, a lot of financial advisors will just do things and not tell you what they're doing. But really, you highly involve your clients in what you're doing, and you illustrate it out to show them why we're doing what we're doing.
Right. And I think for the most part, it's the first time that's ever been done with most of the clients that we see. That they have their mutual funds that they've had in their 401k, and that's about it. They don't really understand what they own. The financial industry is very opaque by design. They don't want you to be able to see what's going on inside, because that would generate phone calls and questions and that they don't want to answer, right? So it's better to just keep you in the dark is how they feel about it. So I kind of reject that. I think that people are more than capable of understanding if somebody's willing to take the time to explain it to them. And so having that understanding will help you stay invested in times like we've had over the last few weeks here when things get rough, but it also will help give us better performance in things as time goes on because we're not constantly trying to work against the plan. So I think that understanding is a big part of it.
So there's total transparency here at Floyd Financial Group. We'll show you what we're doing, but we'll explain why we're doing it as well, too. And you do have a say in this. So that is the planning process. We're talking about the initial consultation here at Floyd Financial Group. Again, our number for you to get yours, 417-889-7233. No cost and no obligation. Okay, we've done the discovery. We've done the analysis. We've done the planning. We've decided that we want to go further. Next is implementation of that plan. What does that involve, Jake?
Yeah, so a lot of times at the end of our second meeting where we've kind of presented some solutions to you and we've talked about those and you've asked some questions, a lot of times what I do from there is we'll set up a third meeting. And what I tell people to do is go home and think about what we've talked about after the second meeting and pray about it if that's something that you do. And we'll set up this third meeting. And if you change your mind and you don't want to come back for the third meeting, you just call me and let me know. But I like to set up a third meeting so that you can have the rest of your questions answered. Because a lot of times what happens after the second meeting, there's a lot of new things that you haven't heard before. You go home that night and you lay your head on the pillow and you go, oh, I should have asked him this, right? And you just write those questions down so that way when we get back together, I can answer any questions that come up. And then you're never going to really hear us say, well, are we going to do this or not, right? So we're blessed enough to be in a situation where I don't really need to bring on a lot of new clients right now. So if it's a good fit, that's great. And if we can get along and what we propose is appealing to you and we have a good understanding, then that's great. If it's not, that's okay too. And if it's not a good fit, we've made a new friend at that point and we'll just go our separate ways. So I'm never going to try to pressure you into anything ever. But at some point, if we attend the third meeting, we answer a few questions, maybe then it's time to start the implementation process. And so that process is where we do paperwork to open accounts and we do calls to roll over 401ks if that's necessary and kind of start to position the investments according to the plan we've created.
So again, the implementation is where we give you your logins, and on the Floyd Financial Group website, there is a client login button there where you can actually log in and see what's happening. Talking with Jake Floyd here at Floyd Financial Group about the initial consultation. Next is the follow-up. What is involved in the follow-up and how often do you follow up with us?
Yeah, so once we implement the plan and everything is in place, usually what we do is we'll do 90-day reviews for a while. So every 90 days we get together and just make sure everything's going according to the way you thought it was going to go. If we set up income, we'll kind of check on, okay, is this enough income? Do we need more income? Maybe if we're not spending all the income, we dial back income so that we're not just simply paying taxes for no reason. Make sure that everything's going good. Make sure you don't have any problems logging in or anything like that. Now, again, people can call me at any time. They don't have to wait 90 days to do that. But usually in the beginning, we'll do 90-day reviews. And then maybe later, after everybody's comfortable, we might spread that out to 6 months or a year. But we want to see everybody at least once a year because a lot of things change. If you change beneficiaries or addresses or phone numbers, we need to know that kind of thing. And life circumstances can just change. But again, in the beginning, we usually do 90 days to make sure that everybody's comfortable. But we also know that you don't want to spend your whole retirement in my office.
And Jake, we've said too that many people have a plan someplace else. We're more than happy to take a look at that plan for you. If you decide that you do want to switch to us here at Floyd Financial Group, I mean, breaking up is hard to do. They say the old song, I'm not a morning person, so waking up is hard to do for me. But anyway, if you are breaking up with your current financial advisor, do we help with that in any way?
Yeah, so there's a lot of ways to do that. If you have a current advisor and he or she has not really been very communicative and that kind of thing, and maybe you don't feel like you want to talk to him even, there's a lot of ways we can just kind of take those investments over and we don't have to have a big, long, drawn-out conversation with that person. You don't have to talk to him at all if you don't want to. If you feel like it's something that you do want to talk to him, then that's fine too. But yeah, we can help do paperwork and things to kind of do everything behind the scenes in most cases so that you don't have to have an uncomfortable situation there.
So again, I want to reiterate that there's no cost and no obligation for you to get your Floyd Financial Group review. We offer it certainly with no judgment. We'll meet you where you are. If you would like to get your review, again, call us today, 417-889-7233. Just leave your name, telephone number. Ashley will give you a call back during the week and set you up with an appointment to come in and sit down with Jake at Floyd Financial Group or Randy when he is in the office, 417-889-7233. If you don't have a plan, this is a great time to get one. If you do have a plan, let us put another set of eyes on that for you. Again, you've got to have a plan, and a plan that includes long-term care and many other things so that you can have a prosperous and a confident retirement. Again, we would love to meet you. Extend a helping hand here, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Jake, we just get started and we run out of time. So I want to wish everybody a happy Easter weekend. Thank you so much for making us a part of your weekend. For Jake Floyd, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Show Me the Money on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, and